Hi, everyone. This is Devins Financial Weekly Stock Analysis Newsletter. Today is 2015, February 15. Our newsletter is for your informational purpose only. We're not responsible for your gains and losses. Let's take a look at current market trend and our strategy. U.S. market is back to the uptrend. Nasdaq is making new highs, and oil sector seem to bottom out. And I'm long the market. My long position are in Nasdaq ETFs and oil and energy related ETFs and some leading stocks. Let's take a look at market indices and their charts. DAX index, this is making a new high. This is a very strong index. Shanghai index is back to 50-day moving average. Nasdaq index. Nasdaq broke the long-term trend range and is making new highs. And mid cap is making new highs as well. Small cap is making new highs. SP 500 is about is actually also making a new high here. Is this a new high? Gold index, gold is back to the downtrend. Now it's back below 50-day moving average. Silver actually finds support at the 50-day moving average. It's a little bit better than gold. Gold mining stock looks like it's heading to 50-day moving average. It's also quite weak. Dollar index is in an uptrend, continue going up, but it has to break above previous high. Otherwise, it looks like short term is in consolidation. Oil index, crude oil price, this one is close to 50-day moving average. It looks like it's about to bottom out from this low of $43, and looks like it's trying to go up. FXI China ETF is in the uptrend. This is U.S. real estate, U.S. real estate ETF IYR. Right now is consolidating. Copper price is still in the downtrend. Real estate mortgage bond fund price is still in the uptrend. Mortgage rate, interest rate is going down in the downtrend. Semiconductor, this breakout from this base. Social media ETF still in a downtrend. Solar ETF looks like this one rebounded. This is a rebound together with the oil. Energy ETF breakout from this bottom here. Financial ETF, this one break above the 50-day moving average in an uptrend. So those are the ETFs. ETFs and indices. Let's take a look at the sector ETF. And right now there are two sectors seems to be can be longed. One is a Nasdaq ETF. Nasdaq is making new highs. The sector is very strong. You've got QQQ, which is 1 times of ETF tracking Nasdaq index, and QLD it's 2 times tracking Nasdaq on a daily basis, twice as much as Nasdaq, going up and down. TECL is tracking the Nasdaq 3 times. Those are the 3 types of ETFs can be used to trade Nasdaq. And then you got a crude oil ETF, USO and OIL. Those are tracking the crude oil price 1 times. UCO is tracking crude oil 2 times. Energy sector stock ETF, XLE is tracking the energy ETF, and DIG is a double of the energy ETF going up and down on a daily basis. ERX is a triple, 3 times of the energy ETF. I'd like to talk about the ETF risk. The first risk is the tracking risk. Some ETF do not track the index very well. For example, if the index go up 1%, some ETF goes up 0.9%. So that doesn't track exactly what the index go up. When the index go down 1%, that ETF may go down 1.1%, for example. So over long term, that ETF has this tracking risk you have to pay attention to. And second, some of the, well, all of the 2 times, 3 times ETF mostly track the index on a daily basis. Over long term, they underperform the 2 times or 3 times of the underlying index. For example, if the index moves from a 100 point to 105, which give you 5% on the first move, and then second day goes down to 100, that will give you 0.79% of the job. The 2 times ETF may go from 100 to 110. That first day that will be 2 times of the ETF's move, which is 10%, and then the second day it also have 2 times of the ETF move, which is 9.52%. That will make the ETF bring the ETF back to 99.5. So the index made a round trip 100 to 105 back to 100. The ETF 100 to 110 and back to 99.5. So the ETF did not go back exactly where it started. It go lower. So over long term, this kind of drifting on a daily basis can make the ETF perform worse than the underlying market, which is 2 or 3 times of underlying market, depends on the multiplier of the ETF. So the 2 times, 3 times ETF and long-term using them for the long-term investing, there is a tracking risk. And then another type of risk is the counterparty risk. For the ETNs, and ETF usually don't have counterparty risk. It is ETN has a counterparty risk. Means the issue company, the company who issued the ETN, if they go bankruptcy, and then your ETN will be at risk. How to reduce the ETF risk? First of all, it's choose ETFs issued by reputable companies. And then second is choose ETFs that have a high trading volume. Those can reduce the tracking risk. And third is using 2 times, 3 times ETF for the short-term trading instead of long-term investing. This can reduce those drifting problem. And then read the chart. If the ETF has a problem, you can see it clearly from the chart. If you compare the ETF performance with the underlying market, you can see the tracking performance, whether it tracks the index well or not. And then always use the stop order for protection in case the ETF had a problem or the index has a problem. You can get out. Okay, let's take a look at the leading stock list. And the first list of the stocks are the ones on the uptrend, but the 2 extended to buy: NXPI and soft company NOW, ServiceNow, and Biogen. And the second list are the stocks that break out but are still in the buy range: AYI, LinkedIn, LNKD, MIDD, and Palo Alto Network, PNNW, ULTA, and VRX, and the Visa. And third, base building. There's no stock building a base right now. And fourth list are the stocks that are in trouble. And let's take a look at their charts, and we can talk about them. First list are the stock that's 2 extended to buy. Biogen, a breakout right here. Now the price is more than 5% above the breakout pivotal point, so 2 extended. ServiceNow, and broke out right here at $71. So right now it's too high. NXP Semiconductor broke out right here, and right now it's also a little too high. It's actually have breakout point here as well. This is also a breakout, and then breakout again. So it's going up in a staircase, like a staircase going in, moving up. This is second list. Those are the stocks that are breakout but are still in the buy range. AYI breakout right here. Actually, it broke out right here and then broke out again right here. Another flat base. LinkedIn gapped away, breakaway gap. This is a gap up, basically a 260. So middle buy Corp, MIDD, broke out at $100.74 right here. Palo Alto Networks break out from the base, long flat base right here. Alta Salon broke out right here. And Visa broke out right here. So those are the stocks are still in buy range. Valiant Pharmaceutical broke out right here. And fourth list are the stocks in trouble. Chubito Mexican Grow gap down with a high volume. This is bad. HDB, this drifting down is also high risk, but it doesn't have as bad as a problem as the other one. Restoration Hardware, downtrend. Tesla, this is a downtrend. This is also very bad. Those are the stocks you should avoid to don't long them. And then what to do in the current market? I'm longing the market through the ETFs. So that's ETF is still a good way to long the market if you don't want to be involved in the individual stocks. And for the leading stocks, and a lot of them have a strong fundamental and they are building bases, and buy them and breakout. That's also a good way to long the market. And always use a stop order for protection. That's all for this week. See you next week.